Hey guys, I had a good morning, and so basically I'll give you a recap of what I'm seeing in the markets. I thought the markets are going to go higher, but I'm getting proved wrong here. It looks like the selling pressure is pretty pervasive here on these markets. We filled both of our gaps on our SPY, came down. This is a prior weekly volume point of control from the first week of February. So we do have some buyers and sellers did meet at these prices at this level, and we are holding above our 2020 open for the year so far. So basically, we've given a lot back on the S&Ps, but we are still showing positive for the year so far. And it really looks like to me that we're just trying to take a breather here in the markets, in my opinion. Uh, our internals are really pretty bearish here so far. We just don't have any major turn. But Europe is closing, and once that closes, the ticks could dramatically change at that point. This selling pressure is being driven by Asia and Europe, and once those markets close, we could definitely see a responsive buy signal in these markets. Okay, go over here to my cues. They are leading the charge downward here. Internals. Here's what I want to point out on the internals. We're getting on the UVOL DVOL. It's getting worse here on our cues. But I want to point out here our advanced declines. It is this absolutely flat line. And that tells me that there is accumulation happening in the cues. So keep that in mind going forward here into the close. We do have a monthly VPOC. Typically, this is a high volume node for the month. I can zoom this out here on my daily time frame and show you where I drew that from. And that VPOC, oh, I need a smaller time frame, sorry. Okay, and that VPOC was made back in, it was made in January. This was built out for January, and we came right down to that, finding a little bit of responsive buying. So January's value is so far holding. This VPOC area is so far holding. So just keep that in mind on this. That is a responsive buy point, and I do think there is accumulation happening here in the Qs. But if you go on to smaller time frames, and like I said, Europe is closing, so you don't want to read too much into it. Typically, what you see on a very bearish tape, you see the bounce, and with a really bearish tape, you will see a close on that high volume point of control. So just keep that in mind as a gravity point today. I can't say for sure once Europe closes that we are going to see responsive buying. This is the first of the week, and all bets are off here. They are accumulating to the short side. It's different than what we've seen in the past. We do have actual accumulation, short positions for, you typically get that for 2 or 3 days. I think we're really probably really only the second day into this, so just keep that in mind that the 9071 area is a definite potential target going forward into the afternoon hours. Okay. And now I'm going to finish with the Russell here. And basically, it's holding out down here at the bottoms. It's really impacted on the yield curves and the healthcare and the energy spaces. All of them were taken on the chin today. But on a relative basis, it's not doing too bad. It's been hit quite a bit versus the other indices. It's already taken a lot of the froth out of that stock, out of this sector. It's still holding into. It's putting in newer lower lows, and it's actually got a positive divergence here on our Russell so far here. So just keep that in mind going forward here. The gravity point would be 1632 if we were to catch bids here. That's the closest point, and it looks like that the developing volume point of control is at that price point. So far, buyers are actually accepting price higher than what it's currently marking going into the European close. So keep that in mind going forward into the afternoon session. Oh yeah, I forgot to show you the quad. Wait a minute, 1 second here. And then on the quad grid on that one, the Russell really, yeah, see, you have a positive divergence. They are actually accumulating the Russell here. So the two most bearish sectors, the Qs and the Russell, I am seeing positive correlation. So that's why I'm really leaning that we are going to rally into the afternoon session. So keep that in mind. I gave you the other thesis, but seeing the tech having that positive divergence says something in my opinion. Okay, TLT. Look at these high volumes in TLT. So we have it range highs, high volumes. Okay, when you have range high, high volume, I do think they are starting to take profits off of the long bond trade. That is my thesis going right here. This is a significant area we crossed above today. Significant resistance. We are trading above it, so I do not think this is the time where you high volume should be buying in. Once you cross above significant resistance, and considering we didn't base out here, if we had based it out here and then we had high volume up here, then that would have been a continuation pattern, in my opinion. We didn't do that. We ran into this above this significant resistance. So I really think, believe that bonds are a shortable entity going into the rest of the week. So just keep that on your watch going forward here. And the VIX, my trade never set up. I was going to get some VIX puts. We're back to the 2288 area. It's just hanging out here. The puts are just too darn expensive right here, right now. It's holding out really well. I really wanted to get see a pop up the 26, 27 area, and then get the 25 or 22 puts. Once we got up to there to get the put 22 puts. Once we got up into that zone, which we may or may not get. So just keep this one on your watch. That is a very defensive sector too, suggesting a lot of fear. But, you know, they were putting on more protection at the open, if you notice here, versus what they're putting on right now. So it looks like the fear trade is starting to wane here, along with the TLT, in my opinion. Okay. Okay, some other things now I want to talk about. Okay, this here is my spider ETFs. And I want to show you how these are laying out here. The most speculative areas in the markets, the areas that have gotten just absolutely were on fire for the past 3 months. Those are the areas taking the biggest hit today. And that's your semiconductors, your consumer discretionary. These are the areas, you know, and here's on your consumer discretionary, we're holding the 2020 open on our consumer discretionary. So this could be a buy point for that on that. And your technology, let's see. Okay. Really holding out sideways here on our technology. It has the most impact with the whole coronavirus thing and international demand and stuff like that. That's the one area that's really taking it on the chin today. And on the grand scheme, if you go out on time, I mean, this thing has just really blown up, really just taken off to the moon. And we've broken this primary uptrend. We're coming right down here to basically this here is this has already been tested once before. This here has acted as support in the past. The 95.31 we have in the pre-market, we have crossed above that. So, you know, we would have to violate that to the downside for me to get a little bit more bearish. But it looks like to me the 97.11 area is a potential target for the close today. So just keep that in mind going forward here. If what I'm seeing, I actually really think there's accumulation going on in this tech. And they also took the other more speculative area, and that's your healthcare. And UNH was leading the charge to the downside here. And to me, healthcare has not bottomed. So from a technical analysis on healthcare, this is not, in my opinion, a really great spot for healthcare. So just keep this one on watch going forward here. We do have like a trend, looks like a trend line support there, but I focus on volume at price support levels. I try to avoid the trend line approach. I think you can get yourself in trouble uh, a lot easier, get a lot more in trouble doing the trend line approach than versus the volume at price. Okay. And then then on the flip side, your defensive areas, your utilities, seeing a little, a bid in your utilities. Keep in mind on your utilities, here's another we've had a very mild winter, and they've already reported how a lot of the utility companies are going to be missing their earnings estimates because of the really light. Uh, uh, it wasn't that cold, so there are a lot less energy use this past winter. So this is a very defensive trade that has gotten extremely overbought. And if they start coming out with a disappointing earnings, this thing can really come unwound pretty quick. So just keep that in mind going forward. And one thing that I really wanted to point out here, and that's your financials. And the fact that they are one of the leaders for today, that suggests to me that this is just a mere short-term blip in the overall scheme. Yes, it looks bad on the chart, but on a relative basis, the financials are still holding out much better than the other more speculative areas in the markets. So if I would have saw financials up there as a leader to the downside, I would be very bearish this market, and we're just not seeing that. The financials have a bid at these price points, and so I'm not. And this is a responsive buy point. See that trend line right here? That is a responsive buy point to the long side on the financials until proven otherwise. And we are getting a little bit of heightened volume here too at these price points. So just keep that in mind going forward here. Pressing your shorts here is quite dangerous in my opinion. Some things to see how big money was going Friday. These are updated at the end of close each day. And these are your ETF fund flows. So even Friday on the dip, you had funds still buying into the Qs. Okay. And yes, the funds, they can get it wrong, but I want to, to understand how money flows are going here. They were loading up on the SPLV. So this is, you get your dividend yields on your S&Ps and you don't take a lot of the volatility risk. And they were adding, that was the biggest thing happening on Friday, that they wanted to be in the S&Ps for the dividend yields because they thought it was far better trade than actually rolling into the TLT. You see how the TLT down here? TLT's gotten awfully expensive here, and for given the relative yields and the 3-to-1, they were still wanting to be in the S&Ps over the TLT, and that tells you a lot of what's going forward here. And then they were selling the S&Ps Friday, of course, and they were getting rid of the highly speculative junk bonds, and that typically you see in a sell-off situation too. They do not want to be in high yield bonds in that kind of situation. And they were even selling utilities. Like I said, utilities is a very risky area to be in going forward here. So okay, that's just some of the ETF the big fund managers. They were rotating. That's how they were doing. Keep in mind, as of yesterday, 1.46 on the 10-year versus 1.60 on the 2 month, and that's actually going to change, even get worse as of today. So we have an inverted yield curve that continues to spread, and this here is really good in the long run, in the fact that if this is sustained at, say, the bonds stay so much in this range or whatever, that's really good for mortgage refinancing, because investors have had 10 years to build up equity in their homes, and U.S. real estate's near record highs right now because there is a shortage in U.S. real estate. So and with Trump just 6 months ago, they changed the lending standards. They made it a little bit more palatable, easier to get credit standards versus what was under Obama. I think a lot of this stuff is going to be a second wave or a quantitative. This is a form of quantitative easing for consumers to refinance their mortgages at extremely lower rates than what they currently have and take out equity in their homes. So keep that in mind going forward here. What's happening right now is actually going to be basically a stimulus. This little fear we're having is going to be a long-term stimulus for the consumer. And consumer credit is at all-time highs right now. So that's another thing to keep in mind. The credit scores for consumers are really, really high right now. So a lot of people can refinance. So keep that in mind going forward. One of the things that caught things really scared Friday, Thursday we had that flash crash, and instead of the Fed coming in and just stabilizing their repo purchases, which they do every day, they went and slashed it in half Friday. That just added more fear to the thing, and then we had to go into the weekend with that overhang of fear, knowing that Powell is wanting to get out of the repo market, wondering what he was going to do today. So that just added fuel to the fire that the Fed was getting out of the repo markets. Well, that helped a little bit today. I know we're not seeing it in the market so far, but they did bump it back up to $40.75 billion, which that is more supportive. It's less than what we were getting last week for the most part, but it did give a tail to the markets, and we can see it in the financials that the Fed is back there to backstop. The Fed put is there to help support these markets. Okay, another thing to really keep on watch here. What's really been the fear trade has been really pumping the dollar up here, and this is another thing that's really causing this sell-off in the markets. Foreign investors are losing money with the dollar going up against their positioning. So whenever the markets give a sell signal and all these foreign investors are losing money on an accelerating dollar, it's a double negative on their positioning. So that's adding fuel to the fire to the downside on our U.S. equities. So if we start seeing a rotation out of these out of the dollar and lower prices on the dollar, we should start seeing foreign investors coming back into U.S. equities. So just keep that in mind going forward. Okay, Mark this morning, first thing, right before the market opened, he was calling out Apple as a long. And I was all over that watching it. And I had never, ever seen Apple down over 5% pre-market when Warren Buffett was on CNBC talking up equities. Never, ever saw that. That's why I wanted to get in Apple to the long side anyway. And then when Mark brought it up, yeah, I was all over that. But at any rate, basically we came down to the 2020 Open on Apple, and I thought, and we also have that solid line there. That's a weekly volume point of control from way back. This is somewhere around here from the first of the year, from the very first week of the year. We do have some volume. You can't see it on this chart, but so basically, I took Apple, had a really nice 2-week gain. My goal for the I doubled my weekly goal for 2 weeks, so I got basically a 2 weeks gain on Apple, and so I managed to get this right off of the right near the 2020 Open and take it for a nice responsive profit this morning. So great call in the room, appreciate it, I love it. So. Then I also took Facebook. Facebook typically trades in tandem with Apple on many occasions, but today, and when it was opening on a significant support area on Facebook. And yes, I could have taken profits out. I thought we were going to get a test of this 20 SMA downward, and I ended up losing money on this trade. It wasn't major, but I did take some. I could tell real quick my options were getting completely and totally bled out. So I hit my stop. I finally just said I chucked it and called it good enough on Facebook. It was a mistake for me to take that trade. And that was the calls. And then I'm in Goldman Sachs because I told you about the financials showing relative strength here. And I saw I got these fairly early. I'm up positive on Goldman Sachs, not really getting very far as of yet. I do think we get this European close behind us here. We might actually see some responsive buying in the financials If we cross below the VWAP, of course, I'm going to check the trade. But I do like the financials to the upside. I think the bonds are on the we're going to come in tomorrow or the next day, and we're going to see a breakdown in the bonds, in my opinion. So that's my bias. Stick with it or not, I don't know, but that's kind of what I'm thinking here. We'll see how the fear is going on with the whole Corona thing, but I do think this is a great opportunity to buy to the long side. Okay, that's it. This is a longer video than normal. I'm sorry about that, but I thought it was really important stuff for me to bring up. And good luck. And if I can get a big spike in the VIX, I am going to get VIX puts around the 27, 28 area for April. So, but so far we're not seeing that. And like I said, I am to the bullish side of the markets, thinking we might have the lows for the weekend. Okay, thanks. Oh, like the video if you like it, please. And if you're seeing stuff that I'm not seeing, please make comments down below. Even if you disagree with my analysis, I mean, I would like to see what you're seeing so you can, so I can add to my knowledge basket. Okay. Thanks a lot. See ya.